answering your questions about retirement. It's Money Talk with Michael Eastham.
Please explain the difference between a bond and a bond fund and when it makes sense to use one over the other.
Another great question. Understanding the difference between individual bonds and bond funds is very important, especially if you are approaching retirement or you're in retirement and you need income. You see, most people think about bonds, they think about bond funds. And that's just the way that the world works. We've been taught that for decades, and the financial industry teaches mostly about bond funds. If you want bonds in your portfolio, then your advisor may suggest, hey, we can use these handy-dandy bond funds over here. But it's very important to understand the difference. You see, for an income investor, it may be better for you to have individual bonds inside of your portfolio. In other words, owning the specific bonds. Why? Because with every bond that you own, you have two very important contracts. One is a contract for interest. They're going to write you checks every 6 months or every 3 months, depending on the terms of the bond. Not only that, but there's a second contract. When that bond matures, you get your principal back, assuming that the company doesn't default or go into bankruptcy. But that's where diversification becomes very, very important. So making sure that you understand those two contracts is key to the distinction between an individual bond and bond funds. Now let's talk about bond funds for a minute. You see, you can own bond funds in your portfolio, but the reality is those two contracts that I just talked about, they're completely off the table. You have no guarantee of income and you have no maturity date. That means a bond fund is actually a perpetual instrument. In fact, by definition, a bond fund is the stock of a company that owns bonds. That means you don't even own those bonds. In other words, if you need income, then you're subject to the liquidity needs of the portfolio manager of that bond fund. And that means that you could be liquidating shares, especially if the bond fund value is dropping. The bond fund manager has to sell shares. He's buying shares with new money that's coming in, and they're selling shares so that you can get income. And that's a very dangerous place, because what that tells me is that a bond fund is much more similar to a mutual fund, a stock mutual fund, than it is individual bonds. So you've got to understand that distinction, because the risk levels inside of a bond fund can be much higher than the risk levels of owning a portfolio of individual bonds. So if you're a conservative investor or you need income and you want to have some bonds in your portfolio, having individual bonds in many cases will be a better way to go. Now, is there a place for bond funds? Absolutely. One of the places where we see that bond funds can be helpful is if you don't have enough money to diversify across a portfolio of individual bonds. Well, a bond fund can allow you to do that simply by buying the shares. You can take a smaller amount of money and diversify it across this entire bond fund portfolio. Now, there's a trade-off to all of that, because bond funds themselves have fees inside of the bond funds. So if you're paying a financial advisor to manage your money and they're using bond funds, well, you're paying a fee to the advisor, plus there's a fee inside of those bond funds. So keep those things in mind as you try to determine what makes the most sense for you. But assuming you've got an allocation that's a reasonable size, then generally speaking, having individual bonds is going to give you a better bang for your buck. Thanks again for that great question.
If you've got a financial question you'd like to have answered, click on the link below to submit your question. You may hear your answer on an upcoming edition of Money Talk.